What's up everyone? Ben here with another video for you. This channel is dedicated to all things personal finance related, helping you earn more, spend less, and invest the difference. Now, if you've been watching the news lately, obviously you know that the coronavirus is going around and people are freaking out about this thing, both about the virus itself and about the repercussions that it is having on our economy. A lot of people are struggling financially, and so they're wondering how are they going to be able to pay their bills coming up? How are they going to be able to pay their rent, their car payments? How are they going to be able to buy food or even toilet paper? The good news is, though, that help is on its way. The government has recently passed a $2 trillion stimulus package known as the CARES Act. Now, as part of this package, each working adult is probably going to receive a check in the mail for up to $1,200 unless you are a very high income earner. And this is also going to be increased by an additional $500 per child under the age of 17. So that's going to help out a lot. Or if you've been recently laid off, your unemployment benefits should go up by $600 per week as part of this stimulus package. And this stimulus check or increased unemployment benefits, they're going to go a long way towards helping a lot of people. But what if you need money now? What if you can't wait for that stimulus check to come in the mail? What can you do to access some money immediately? Well, the good news is that as part of this CARES Act, this $2 trillion stimulus bill, they also put in some provisions to allow people to access money in some of their retirement accounts very, very easily. And I know immediately what some of you guys are thinking. You're saying you should never, ever take money out of your retirement account. And 99.9% of the time I would agree with you, and this is the one exception. So there's really two reasons why you should never take money out of a retirement account. And the first one is that's your retirement account. So by taking money out of your retirement, you are really just robbing from your future self. So you may never be able to fully retire, or at least not retire with the quality of lifestyle that you are hoping for if you take money out of that account. And the second reason that you typically never want to take money out of a retirement account is there's some taxes and penalties involved. And especially these penalties make it so it's just not efficient to ever do this. But as part of the stimulus package, they have eliminated or drastically reduced all of these problems so that you can access your money easily in a time of crisis such as this to get you through. So maybe you have a 401k at work, or you contribute to an IRA, an individual retirement account on your own. Whichever the case may be, you are going to be able to take a withdrawal from this account in the amount of up to $100,000 with very minimal problems. So any of these withdrawals are going to be considered a qualified distribution as long as they are related to COVID-19, the coronavirus. So a qualified distribution is not going to have all of the penalties, that 10% penalty assessed to it. But you may still owe some taxes on it. So if you're taking this money out of a traditional 401k or a traditional IRA, typically you're going to owe money on these accounts when you take money out of it. But the good news is, in this situation, you have two options. You can either choose to be taxed immediately, all in one lump sum, or you can spread out that tax burden over a 3-year period. And this is going to be very beneficial because if, for whatever reason, your income is unusually low for this year, maybe you were unemployed for the majority of it, or you own your own business, but your business was struggling due to this virus, and so you weren't able to make as much money as you typically make, that's going to put you in a very, very low tax bracket. So in a situation like this, you might want to just simply pay the tax penalty all at once and just get it over with, since you're already in a very low tax bracket. Alternatively, you can choose to spread it out over 3 years, and that's going to keep your taxable income nice and low and nice and steady throughout that 3 years. And so this is going to be helpful for people that earn a little bit more money and they don't want to be taxed all at once. That's going to put them into a super high tax bracket. And the good news about this is that you have all the way until April of next year when you file your taxes to choose if you want to be taxed all at once or if you want this money to be spread out over a 3-year period. So you can evaluate all of 2020 and see what your taxable income is going to be and then make a decision after that, all the way in April of 2021, how you want to be taxed on this. But since ideally you are taking this withdrawal just to get you through some tough times, and if better times are ahead and you're actually able to, get a good income going once again, you can actually put this money back into your 401k or your IRA. And as long as you put all of the money back that you withdrew within a 3-year period, then none of that withdrawal money is going to be taxed. Instead, it is simply going to be treated as a rollover contribution. Now, 401ks also have a second option for accessing their money. This option is not available to an IRA, it is strictly a 401k option. So with a 401k, you can still do the withdrawal and you can still put it back within 3 years if you're interested. But with a 401k, you can actually take a loan out against your 401k. And the same limits apply. You can withdraw up to $100,000. Now with a 401k loan, you do have to repay it. But the good news is that you have a 5-year period in order to actually repay this. So theoretically, your payments are going to be relatively low. You've got a couple of extra years in order to get all of this money back inside of your account. And that's going to be a little bit beneficial as opposed to a withdrawal where you only have 3 years to put it back if you want. You don't have to put it back, but if you want, you have 3 years to put it back. But with a loan, you do have to put it back. You obviously have to repay this loan, but you have a little bit longer to do it, so you have 5 years to repay this loan. Now, a 401k loan does get charged interest, but that interest is actually payable to you. You are paying yourself by paying additional money into this 401k. So all that interest that you're being charged is actually being paid right back to you. So the interest rate doesn't really matter because you're the one that's collecting this interest. Now, one of the downsides about a 401k loan is that if you do terminate your employment with your boss for whatever reason, if you are no longer working for that company that is giving you that 401k, then immediately the remainder of that loan is due in full, and if you can't repay it, then you get taxed and penalized on it. So you want to make sure that you have a very stable job, that you're not expected to go anywhere for the foreseeable future, that way you have time to actually repay this loan. If you think that you may not be at this location for the next 5 years, it may be better simply to make a withdrawal and then repay as much of that as you can within that 3-year period, as opposed to a loan and then risking calling it due once you leave your current employment. So there you guys go, how withdrawing from a 401k or an IRA might be a viable solution in this case to solve your current financial problems. If you found this video educational or if you got something useful out of it, be sure to leave a comment down below, give it a like. It really helps out the YouTube algorithm. And as always, be sure to subscribe. I have new videos every week. Thanks, and I'll see you all again real soon.